Higher rental rates and robust finance lease income have put DDMPR in the spotlight after reporting narrowly higher earnings for the first half of 2026. Investors may notice the headline. Net income reached 786.1 million pesos, up a modest 0.5%. Total revenue echoed this pace, at 1.004 billion pesos. A subtle gain, but one that masks a complex interplay among income streams. Rent income, typically the backbone for any property trust, advanced just 0.4%. Management credits rate increases, but the underlying story is more nuanced. Interest income soared nearly 39%, thanks to stronger finance leases and cash equivalents. Yet, gains elsewhere were offset by a decline in other income, underscoring the challenge of relying on sources beyond recurring rent. Peering into second quarter results sharpens this contrast. Revenue grew 3.9% year-over-year, but rent income declined 3.2%. Other income and interest income filled the gap, meaning headline growth leaned on less predictable sources. For investors, that shift raises questions. Can DDMPR rely on non-core revenue as a durable engine, or is this a temporary patchwork? The real obstacle is occupancy. Blended occupancy stood at just 64.55%. More than a third of leasable space remains vacant. Double Dragon Plaza dominates the rent base, accounting for over 80% of first-half rental income. That concentration makes progress in leasing at flagship properties critical. Filling space is the most direct way to revitalize revenue, especially given relatively short weighted average lease expiries that create both opportunities and risks. Frequent renewal means chances to reprice, but also greater exposure to vacancies. Expense management has quietly strengthened results. Net income for the second quarter rose almost 6% thanks to a 3.2% decline in costs and expenses, led by sharp drops in marketing and interest expenses. For the half year, bottom-line growth matched revenue gains, reflecting tight cost control, but also rising utilities and property maintenance. Yet liquidity is tightening. Cash fell 74% due to hefty dividend payments, while receivables expanded by double digits. High margin and low leverage remain strengths, with investment property making up nearly all assets and no bank or intercompany debt. Ultimately, DDMPR enters the second half with stable earnings, a resilient portfolio, and virtually no debt. However, growth hinges on bridging the occupancy gap. Until more vacant space is filled, dividend-paying capacity remains strong, but organic revenue expansion is muted. For investors, collections and leasing progress will be central as the trust balances respectable profits against the need for sustained, rental-driven growth.